The gates still open every morning. Gravel driveways curve toward a residence no one approaches. Windows reflect landscaped gardens that have never been lived beside. Inside, climate systems quietly protect rooms that remain unused. Security lights trace the outline of a mansion built to be occupied, but never was. This estate wasn't damaged. It wasn't seized. It wasn't unfinished. It was completed, furnished, and fully operational. Every decision behind it made sense. Every financial model checked out. Every expert approved the structure, and yet ownership dissolved. Buyers disappeared, and the mansion was quietly abandoned. So the question isn't why this luxury estate failed. The question is harder. Was this mansion abandoned because of one financial mistake, or was it never survivable the moment that mistake was made? For projects at this level of wealth, failure is not supposed to exist. The mathematics of extreme capital suggest that billionaire-scale ventures carry built-in insulation, diversified portfolios, legal structures that distribute risk, advisory teams that model every scenario before ground breaks. At a certain altitude of wealth, the assumption is that mistakes become impossible. Not because the wealthy are smarter, but because they can afford to purchase expertise that prevents error. This mansion was conceived within that protective envelope. The buyer operated at a level where $100 million decisions were routine. The development team included architects whose portfolios contained palaces across 3 continents. The financing structure involved institutions that had underwrote luxury projects for decades without a single default. The property sat on 12 oceanfront acres in an established enclave. Neighboring estates sold reliably in the 30 to 50 million range. Location was verified. Market depth was confirmed. Comparable sales data stretched back 40 years, showing steady appreciation even through recessions. Construction began in late 2016. Limestone from the same Italian quarries that supplied restoration work at Versailles. Custom millwork fabricated in Germany by workshops that had served royal families. Glass from a manufacturer in Belgium whose panels required 6 months of lead time. The project employed craftsmen whose waiting lists typically extended years. Every material choice reinforced the same message. This residence would represent the absolute peak of what money could build. Not experimental architecture, not avant-garde design, classical excellence executed with modern precision. The initial budget was set at $65 million. Substantial but not alarming for a property of this scale. Comparable estates in the same market had recently completed at similar figures. The buyer's liquid assets exceeded $2 billion. Financing $65 million represented roughly 3% of total wealth. Conservative by any measure. Completion was projected for early 2019, a timeline that aligned with the buyer's business schedule and personal plans. The mansion would serve multiple functions: primary residence, entertainment venue for corporate hospitality, and asset appreciating within a portfolio otherwise concentrated in equities and private company holdings. On paper, every element aligned: wealth sufficient to absorb overruns, location proven to hold value, construction team with flawless track record. Financing that represented a minor allocation within a much larger fortune. The project launched with confidence that bordered on certainty. Within 36 months, that certainty would be proven catastrophically wrong. This wasn't built for comfort, it was built for balance sheets. The buyer's identity remained deliberately obscured throughout the project. Public records listed ownership through a Delaware limited liability company, itself owned by a trust, domiciled in the Cayman Islands. The structure was standard. For high net worth real estate, privacy protection, liability insulation, and tax optimization layered into every legal entity. What is known comes from construction permits, contractor interviews, and financial filings that emerged later. The buyer had made a fortune in technology infrastructure, not consumer-facing platforms. but the underlying systems that powered cloud computing and data centers. The wealth was recent, accumulated over roughly 15 years, but substantial. Forbes estimates from the period placed net worth between $2 and $3 billion. This background matters because it shaped how the mansion was conceived. The buyer approached real estate the way successful tech entrepreneurs approach everything, as an engineering problem with optimal solutions discoverable through analysis. The mansion would not be built on intuition or aesthetic preference alone. It would be built on data. Market research identified the specific neighborhood as statistically superior. Property values had appreciated an average of 6.7% annually over the previous 2 decades. Sales velocity remained strong even during the 2008 financial crisis. The buyer pool was global. Wealthy families from Asia, Europe, the Middle East, and North America all competed for addresses in this enclave. The architectural program was developed with similar rigor. Square footage was determined by analyzing comparable sales. Properties above 20,000 square feet commanded premiums. Properties above 30,000 square feet entered rarefied territory where buyers were scarce, but pricing was unconstrained. The decision was made to target 32,000 finished square feet, large enough to justify exceptional pricing, small enough to maintain some connection to market comparables. Amenities were selected through analysis of what ultra-high net worth buyers valued. A theater, because every comparable property had one. A wine cellar, because it signaled sophistication and could be photographed for lifestyle publications. A spa and fitness center, because wellness had become the new status marker among the global elite. An art gallery, because the buyer's collection required climate-controlled display space, and because gallery space could be valued separately for insurance and estate planning purposes. The design process lasted 14 months. Revisions focused not on personal preference, but on maximizing theoretical resale value. Every bathroom was finished in marble from the same Portuguese quarry, not because the buyer cared about marble sourcing, but because consistency would photograph well and communicate attention to detail that future buyers would recognize. This was not a home in the traditional sense. It was a financial instrument wrapped in stone and glass, a vehicle for storing wealth that happened to take the form of a residence. The buyer intended to occupy it, certainly, but occupation was secondary to the assets. Primary function, appreciation. The assumption was straightforward. Build the finest property the market had ever seen. Cost would be recovered through value appreciation over a 5 to 7 year hold period. Then either continue occupying an asset that had grown wealth passively, or sell at a profit that would justify every dollar invested. The logic was sound. The math was clean. The execution would be flawless. The mistake was already made. The real mansion wasn't the building. It was the financing behind it. Construction projects at this scale do not get funded the way normal homes are purchased. The buyer did not write a check for $65 million and wait for contractors to finish. The financing was structured as a series of coordinated instruments, each serving a specific purpose, each carrying distinct risk. The primary vehicle was a construction loan from a private bank that specialized in lending to ultra-high net worth individuals. The institution had financed yacht purchases, art acquisitions, and estate developments for clients whose names appeared regularly in business publications. The loan was structured as a credit line with draws released upon completion of construction milestones. Foundation complete, $10 million available. Framing complete, another $8 million. Finishes substantially complete. Final balance released. The loan carried an interest rate of 4.8%. Not cheap, but reasonable for a project of this size, with no government backing or secondary market for the debt. The term was 3 years, matching the projected construction timeline. Upon completion, the loan would convert to a conventional mortgage or be paid off from asset sales elsewhere in the buyer's portfolio. Collateral was not the mansion itself. During construction, the unfinished property had limited value as security. Instead, the buyer pledged securities, stocks and bonds held in a separate account at the same private bank. The pledged portfolio was valued at $90 million, comfortably exceeding the loan amount and providing the bank with cushion should the buyer default. This structure created leverage. The buyer could access capital for construction without liquidating investments that were performing well. Those investments could continue generating returns while the mansion was built. Upon completion, the property itself would presumably be worth more than the cost to build it, allowing the buyer to refinance against the completed asset and release the pledged securities. On paper, this was elegant. In practice, it introduced three vulnerabilities that were not apparent at the start. First, the construction loan accrued interest immediately upon each draw. Every $1 million borrowed began costing $48,000 annually from the moment it was released. Over a 3-year construction period, interest expense alone would exceed $9 million. That cost was acceptable if the completed property could refinance at lower rates or if the buyer's liquid assets covered the expense comfortably. But it represented real cash outflow that had to be serviced regardless of whether the mansion generated any return. Second, the pledged securities remained exposed to market volatility. If the stock market declined significantly, the value of the collateral would fall. The bank had the right to demand additional collateral or partial loan repayment if the pledged portfolio dropped below a specified ratio to the loan balance. This was standard practice, designed to protect the lender. But it meant the mansion's financing was indirectly tied to equity market performance, a risk that had nothing to do with the property itself. Third, the construction loan had a maturity date. If the project ran over schedule or if refinancing proved difficult for any reason, the entire loan balance would come due. The bank would not extend indefinitely. At maturity, the buyer would either need to pay off the loan in full or convince another lender to provide takeout financing. Neither option was guaranteed. These vulnerabilities were known and disclosed. They appeared in loan documents and were certainly discussed with the buyer's advisors. But they were treated as theoretical risks, the kind of contingencies that careful people plan for but don't expect to encounter. The assumption was that construction would finish on time, the property would appraise at or above cost, and refinancing would be straightforward. After all, the buyer had substantial wealth beyond this single project. Liquidity might be needed, but liquidity existed. That assumption, that liquidity would be available when needed, would prove to be the fulcrum on which everything else would collapse. Every number worked, as long as one thing stayed true. The entire financial structure rested on a single premise. The completed mansion would be worth at least what it cost to build, and probably more. This was not a wild assumption. Luxury real estate in established markets typically holds value. Cost is not the same as value, but at high price points, the two often converge. If you spend $50 million building a waterfront estate in a neighborhood where comparable properties trade between 40 and 60 million, the presumption is that your property will find a place within that range. The assumption was reinforced by recent history. Between 2010 and 2016, luxury home prices in the target market had risen steadily. Properties that sold for $20 million in 2010 resold for $35 million in 2015. The gains were not speculative frenzy. They reflected genuine demand from a growing class of global ultra-wealthy buyers seeking trophy properties in stable jurisdictions. Appraisals conducted during the planning phase supported the assumption. Independent valuation firms hired by the bank projected completed value between $80 and $90 million. Those figures were based on comparable sales, adjusted for the superior quality and scale of what was being built. The appraisals were conservative by design. Banks do not lend based on optimistic projections. They lend based on defensible numbers that will hold up if the loan defaults and the property must be sold. The buyer's advisors modeled multiple scenarios, Even in a downturn, they argued, the property would hold 60 to 70 million in value. Worst-case projections still showed the asset covering the debt, with some equity remaining. The analysis was thorough and professionally executed. Yet the assumption contained a flaw that no model captured. The flaw was not about price, it was about liquidity. Price is what a property is theoretically worth. Liquidity is whether you can actually sell it at that price within a time frame that matters. The two are related but not identical. A Picasso might be worth $50 million, but if you need to sell it within 30 days, you might only receive 35 million. The difference is the liquidity discount, the cost of urgency. Luxury real estate is inherently illiquid. The buyer pool is small, transactions take months to structure. Financing is complex. Due diligence is extensive. Even in strong markets, properties at the highest price points can sit unsold for years. The models assumed liquidity would exist when needed. They assumed that if the buyer ever needed to sell, a buyer would materialize within a reasonable time frame at a reasonable price. This assumption was embedded so deeply in the analysis that it was rarely stated explicitly. It was simply taken for granted. And it was wrong. Not wrong in the sense that the property had no value. Wrong in the sense that value without liquidity is theoretical. When pressure comes, and pressure always comes, theoretical value does not pay bills. Liquidity does. The mansion was being built on the assumption that it could be sold if necessary. That assumption was never tested during construction. By the time it needed to be tested, the answer would arrive too late to matter. The moment it became an asset first, living became secondary. Construction proceeded smoothly through 2017 and into 2018. Limestone walls rose according to schedule. Glass panels were installed without incident. Interior finishes progressed methodically. The project stayed close to budget, with overruns limited to areas where the buyer approved upgrades. But somewhere during those 2 years, the property's purpose shifted. Initially, the buyer spoke of the mansion as a residence, a place to live, to host, to enjoy. Communications with architects referenced family life, entertaining guests, personal comfort. The language was domestic. That language gradually changed. By mid-2018, conversations focused more on comps, appraisal value, and optimal timing for refinancing. The buyer's attention shifted from how the house would feel to what the house would be worth. Decisions about finishes and amenities were increasingly driven by resale considerations rather than personal preference. This transformation is common in high-end real estate, though rarely acknowledged. At a certain price point, properties stop being homes and become assets. They are bought, held, and sold like stocks or bonds. The fact that someone might live in them is incidental to their primary function, storing and growing wealth. The shift has consequences. A home is used, an asset is maintained. The two require different mindsets. A homeowner accepts that their house will age, that children will mark walls, that daily life will create wear. An asset holder preserves value. Rooms are kept pristine. Systems are maintained meticulously. Occupancy is minimized to prevent depreciation. As the mansion approached completion, the buyer's behavior reflected asset thinking rather than homeowner thinking. Furniture selections were made not based on comfort, but on what would stage well for future sale. Landscaping was designed for curb appeal, not personal use. Security systems were specified to the level expected by future buyers, exceeding what the buyer personally required. The property was being optimized for theoretical future owners before the current owner had ever occupied it. This mindset made sense within the logic of wealth preservation, but it created a psychological distance. The buyer never fully inhabited the idea of this mansion as home. It remained, in their mind, an investment that happened to be habitable. That distance would matter when pressure arrived. Letting go of a home is emotionally difficult. Letting go of an underperforming asset is a spreadsheet decision. Being rich doesn't mean you can sell. The buyer's net worth on paper was substantial. Equity stakes in companies, shareholdings in publicly traded firms, real estate holdings in multiple cities, art, collectibles, assets summed to over $2 billion. But wealth is not the same as liquidity. Wealth is what you own. Liquidity is what you can convert to cash quickly without significant loss. Most of the buyer's wealth was locked in positions that could not be easily liquidated. The company stakes were private, with shareholder agreements restricting sales. Public shareholdings were large enough that selling would require SEC filings and could move the stock price. Real estate takes months to sell. Art might be valuable, but auction houses require lead time and take substantial commissions. Truly liquid assets, cash, money market funds, easily sold securities, amounted to perhaps $300 million. Still a fortune by normal standards, but not infinite, and subject to competing demands. By late 2018, several pressures were converging. The buyer's primary company, which had generated most of their wealth, was facing competitive challenges. Revenue growth was slowing. A planned IPO had been delayed. The buyer's paper wealth remained high, but the trajectory was no longer unambiguously upward. Simultaneously, other investments were underperforming. A venture capital fund had made several bad bets. A hedge fund allocation had lost money. These were diversification moves that were supposed to reduce risk. Instead, they were consuming capital. The mansion construction loan continued accruing interest. By the end of 2018, the loan balance stood at $58 million. Interest expense was running at approximately $3 million annually. The buyer was servicing that debt from cash flow, but the drain was beginning to strain liquidity. None of these developments constituted crisis. The buyer was not insolvent. Net worth remained comfortably positive, but the buffer was narrowing. Liquid capital that had once seemed inexhaustible was being drawn down month by month. And then came the call from the bank. The day construction ended, the financial clock started running. The mansion was completed in March of 2019. Final inspections passed. Certificates of occupancy were issued. Contractors demobilized. The property stood ready for occupancy. The moment completion was certified, carrying costs became fully operational. Property taxes in the municipality were assessed at 1.4% of value annually. The tax assessor valued the completed mansion at $72 million. Annual property tax, just over $1 million. Insurance for a property of this size and value required specialty underwriters. Coverage for the structure, contents, liability, and flood risk totaled $850,000 annually. Utilities and climate control ran continuously, regardless of occupancy. Electric bills averaged $18,000 per month. Natural gas for heating added another $6,000 in winter months. Water and sewer services, though minimally used, still carried base charges of $3,000 monthly. Staffing was minimal compared to historic mansions, but still substantial. A property manager oversaw the estate at an annual salary of $120,000. 2 groundskeepers maintained 12 acres of landscaping at $75,000 each. A house manager conducted weekly inspections and coordinated vendors at $90,000 annually. Security monitoring through a private firm cost $48,000 per year. Maintenance was ongoing. HVAC systems required quarterly service contracts totaling $32,000 annually. Pool and water features needed chemical treatment and equipment maintenance at $24,000 per year. Pest control, gutter cleaning, power washing, window cleaning, and seasonal decorative work added another $40,000. These were not discretionary expenses. They were the cost of preventing decay. A mansion this size deteriorates rapidly without constant attention. Water intrusion, mold, pest infestation, mechanical failure, neglect for even a single year can create damage, requiring hundreds of thousands to repair. The annual carrying cost totaled approximately $2,800,000. None of it was generating return. The mansion was not rented. The buyer had not moved in. The property sat complete, maintained, guarded, and entirely unproductive. Meanwhile, the construction loan remained outstanding, $58 million at 4.8% interest. Annual interest expense, $2,784,000. Combined, the property was consuming roughly $5.5 million per year. To service that cost, the buyer needed either substantial liquid reserves or the ability to refinance the construction loan into a lower-cost mortgage. The plan had been refinancing, replace the expensive construction loan with a conventional mortgage at perhaps 3% interest. That would cut annual interest expense by over $1 million. With a mortgage in place, the buyer could either occupy the property or sell it from a position of financial stability rather than urgency. Refinancing required an appraisal. The bank ordered one in April of 2019. The appraised value came back at $63 million. Lowering the price would have destroyed the story holding everything together. $63 million was defensible but devastating. The appraisal was based on comparable sales over the previous 12 months. Luxury real estate in the area had softened slightly. Not a crash, just a quiet flattening after years of steady gains. Properties that might have sold for $50 million in 2017 were now selling for $47 million. The market had not collapsed. It had simply stopped rising. For a property built at a cost of $65 million, including land, finishes, and soft costs, a valuation of $63 million meant the buyer was underwater. Not deeply, but enough to create problems. The construction loan was $58 million. The appraised value was $63 million. On paper, there was still $5 million in equity. But banks do not lend against 100% of appraised value. They lend against a percentage, typically 70 to 80% for luxury properties. 80% of $63 million is roughly $50 million. The buyer needed a $58 million mortgage to pay off the construction loan. The property would only support a $50 million mortgage. The gap was $8 million. $8 million had to come from somewhere. Either the buyer paid down the construction loan by $8 million before refinancing, or the buyer found a lender willing to accept higher leverage. The first option required liquidity the buyer increasingly lacked. The second option was unlikely. Banks were already nervous about luxury real estate exposure after seeing market softness. The buyer made inquiries with other lenders. None were interested in financing above standard ratios. The message was consistent. Pay down the loan or keep the construction financing in place until the property could be sold. Selling became the obvious solution. If the property truly appraised at $63 million, perhaps it could sell for $65 or $68 million. Real estate often trades above appraisal, especially if the property is unique and well marketed. A sale would eliminate the debt, recover most of the investment, and allow the buyer to move on. The property was listed in June of 2019 at $89 million. That price did not reflect appraisal, it reflected aspiration. At $89 million, the buyer would recover full cost and realize a gain. It was the number that justified the entire project. But $89 million was 40% above appraised value. It was double the median sale price in the neighborhood over the past year. It positioned the mansion as the most expensive residential property ever offered in the area. The pricing strategy was deliberate. Luxury real. Estate at the highest tier is often priced based on what sellers need to believe, rather than what markets will pay. The logic is that billionaire buyers are irrational, that someone will fall in love with the property and pay whatever it takes. Sometimes this works. Usually it does not. Months passed. Showings were infrequent. Interest was minimal. The property sat on the market through summer and into fall. No offers materialized. In October, the listing price dropped to $79 million. Still well above appraisal, but closer to reality. The reduction signaled distress, though the listing agent framed it as strategic repricing. By December, one offer had been received, $52 million. The buyer rejected it immediately. Selling at $52 million would mean recognizing a loss of over $13 million. It would mean admitting the project had failed. It would mean the assumptions that justified construction were wrong. The price could not come down further, without destroying the narrative. And the narrative was all that remained. Debt doesn't care about aesthetics. The construction loan matured in March of 2020. At maturity, the full balance, $58 million, would come due. The bank would expect repayment or a clear path to take out financing. Neither was available. Refinancing required appraisal support the property did not have. Sale required a buyer who did not exist at the listed price. The only remaining option was extension. Convince the bank to extend the loan and allow more time to resolve the situation. Extension negotiations began in January. The buyer argued that the property was exceptional, that finding the right buyer required patience, that forced sale would destroy value for everyone. The bank reviewed the situation. They saw a borrower whose liquidity was tighter than it had been at loan origination. They saw a property that had been on the market for 7 months without selling. They saw a loan secured by collateral that was no longer clearly sufficient. The bank offered a 6-month extension at increased interest, 6.5%. The higher rate compensated for increased risk and encouraged faster resolution. The buyer accepted. There was no alternative. The extension pushed maturity to September 2020. Interest expense increased from $2,784,000 annually to $3,770,000. Another $1 million in carrying cost added to an already unsustainable burn rate. By this point, the mansion was consuming roughly $6.5 million per year. Property taxes, insurance, maintenance, staffing, and interest. Money flowing out, nothing flowing in. The buyer's liquid reserves were depleting. Asset sales elsewhere in the portfolio were being considered, but markets were volatile and selling into weakness would lock in losses. Then came March 2020. COVID-19 was declared a pandemic. Financial markets collapsed. Luxury real estate froze. Showings stopped entirely. Buyers disappeared. The mansion had been an illiquid asset. It was now effectively unsellable. This project didn't collapse. It aged out of survivability. The pandemic did not cause the mansion's failure. It accelerated a process already underway. Even before COVID, the fundamentals were deteriorating. The property was overpriced relative to market conditions. Carrying costs were unsustainable. The buyer's liquidity was stretched. The construction loan was a ticking clock. These problems existed independent of any virus. But the pandemic removed the last escape routes. Selling became impossible. Refinancing became unthinkable. Banks were retrenching, tightening standards, avoiding new exposure. The buyer's other assets, which might have been liquidated to cover mansion costs, were falling in value as markets crashed. Time, which had once seemed abundant, became the enemy. Every month, another $500,000 in carrying. Costs. Every month, another interest payment. Every month, the buyer's financial position weakened while the property's market position did not improve. The listing price dropped again in May of 2020 to $69 million, then to $65 million in July. Each reduction was an admission of reality, a step closer to acknowledging that the appraisal had been correct and the aspirations had been wrong. At $65 million, the price exactly matched total project cost. Selling at this price would mean recovering the investment with no gain. It would mean years of effort, millions in carrying costs, and incalculable stress had produced zero return. But zero is better than negative. At $65 million, the buyer could escape without catastrophic loss. No one offered $65 million. The highest offer received was $57 million, and it came with conditions: extended due diligence, financing contingencies, repairs to be completed before closing. Accepting would mean netting perhaps $54 million after costs, a loss of over $11 million. The buyer declined. The logic was sunk cost fallacy operating in real time. So much had been invested that accepting loss felt impossible. Surely the market would recover. Surely a buyer would appear. Surely holding on a bit longer would result in a better outcome. But time was compounding the problem, not solving it. Every month the property sat unsold was another $500,000 in costs. Every month without a buyer was another month of deteriorating negotiating position. Waiting was not a strategy. It was hope disguised as patience. The loan extension expired in September of 2020. The bank declined to extend further. They wanted out. Their options were limited: force a sale at auction, assume ownership through foreclosure, or negotiate a voluntary deed in lieu. None were attractive. Foreclosure on a $60 million property would be costly, time-consuming, and likely to result in recovery below the loan balance. Auction would be public, messy, and would create a comparable sale that could damage other luxury properties the bank had financed. The bank proposed a solution. The buyer would deed the property to the bank voluntarily. The loan would be forgiven. The buyer would walk away with no further obligation. The bank would take ownership, manage the property, and attempt a sale at a more realistic price. This was the cleanest exit available. No foreclosure, no public record of default, no deficiency judgment pursuing the buyer's other assets. Just a quiet transfer of title and a mutual agreement to move on. The buyer agreed in November of 2020. The mansion, completed less than 2 years earlier, changed hands without a dollar changing accounts. Ownership simply shifted. The buyer lost their equity stake, their years of effort, and roughly $18 million in costs and interest. The bank gained a property they did not want and would struggle to sell. The mansion stood empty, complete, and abandoned. Even billionaires run spreadsheets. The bank listed the property in January of 2021 at $58 million. This was not a strategic price. It was the loan balance. The bank needed to recover their exposure. Anything above $58 million would be profit. Anything below would be loss. At $58 million, the property was finally priced close to market reality. But market reality had shifted. Luxury real estate had not recovered post-pandemic as quickly as other asset classes. Wealthy buyers were cautious. Many were reassessing their property portfolios, selling rather than buying. The demand that had supported trophy properties through the 2010s had evaporated. Interest was limited. Showings occurred, but buyers struggled with the same problem the original buyer had faced. The numbers did not work. Consider a hypothetical buyer with $2 billion in net worth looking at a $58 million purchase. They would likely finance part of the acquisition. Even the very wealthy use leverage to preserve liquidity. Assume they put down 30%, roughly $17 million, and finance the remaining $41 million at 4% interest. The mortgage would carry annual interest of $1,640,000. Add in property taxes of $1 million, insurance of $850,000, maintenance and staffing of another $1 million, utilities of $300,000. Total annual carrying cost, approximately $4 million. That $4 million generates no return. The property does not produce income. It does not appreciate automatically. It is simply a cost. For a billionaire, $4 million is manageable. But it is $4 million that could be invested elsewhere. In equities earning 7%, $4 million annually grows to over $5 million in returns. The opportunity cost of tying up capital in the mansion is substantial. Then there is liquidity risk, buying. The property ties up $17 million in equity and creates $41 million in debt against an asset that is difficult to sell. If the buyer's financial situation changes, Business struggles, market downturn, personal crisis, the mansion becomes a trap. Selling takes months, maybe years. Meanwhile, carrying costs continue. Every potential buyer ran versions of this analysis, and every time the conclusion was the same. The property was beautiful, impressive, and financially irrational. The mansion was not unsellable because it lacked value. It was unsellable because the cost of ownership exceeded what the property could justify, even for someone who could technically afford it. Wealthy buyers are not irrational. They are wealthy because they make decisions that preserve and grow capital. A mansion that consumes $4 million annually while offering uncertain resale value fails that test. The property sat through 2021. The listing price dropped to $52 million in June, then to $48 million in October. At $48 million, the bank would take a loss of $10 million on their loan. But $10 million was better than holding the property indefinitely and watching carrying costs compound. Still, no sale. The market had spoken. At any price that allowed the bank to escape without catastrophic loss, buyers were not interested. At prices where buyers might have been interested, perhaps 35 or 40 million, the bank would recognize losses so large that management would face serious questions from regulators and shareholders. The mansion sat, maintained but unused, guarded but unoccupied, a financial orphan too expensive to keep, too painful to sell. At a certain point, ownership stops being desirable. By 2022, the mansion had become an accounting problem. The bank had restructured the loan internally as a non-performing asset. Reserves were set aside to cover expected losses. The property appeared on quarterly reports as a drag on profitability. But walking away entirely was not simple. The bank could not just abandon the property. They had a legal interest secured by the deed. Abandonment would trigger municipal code violations, potential environmental penalties, and liability if trespassers were injured on the site. So they maintained it. Climate systems ran continuously, preventing mold and humidity damage. Landscaping was kept to avoid blight complaints. Security patrols prevented vandalism. The property consumed roughly $150,000 monthly in management costs. Not as high as when the original buyer occupied it, but still substantial. These costs were pure loss. The property generated no revenue. It appreciated in value only to the extent that the overall market rose and luxury real estate was stagnant. Every month of holding represented $150,000 in unrecoverable expense. The bank explored alternatives. Lease the property to generate some cash flow? No one wanted to rent a $50 million mansion. The pool of potential tenants was vanishingly small, and lease rates that would cover carrying costs were impossible. Subdivide the land and sell parcels? Zoning restrictions prohibited division. Municipal regulations required the property to remain single-family residential. Donation was considered. Gift the mansion to a non-profit. Claim a tax deduction. Let someone else deal with it. But non-profits did not want it. Operating a property this size would consume budgets. Converting it to a museum or event space would require permits, renovations, and staffing. Most non-profits had no use for a $65 million mansion they could not afford to run. The property was trapped in a category where ownership was a liability regardless of who held title. Too expensive for normal buyers, too large for practical use, too illiquid to flip, too costly to maintain. The bank, which had financed the project expecting routine repayment, was now stuck with an asset they could not monetize. This is the dark endpoint of extreme luxury real estate. Projects are conceived and built with confidence that wealth ensures success. But wealth cannot compel buyers. It cannot create liquidity. It cannot prevent markets from shifting. At a certain point, magnitude itself becomes the problem. The mansion was too grand, too costly, too specific to the original buyer's vision. It was built for one person and no one else wanted it. The bank's best move was waiting. Hold the property, minimize costs, and hope that time and market recovery would eventually produce a buyer. Not an optimal strategy, just the least bad option available. The mansion remained empty. Rooms untouched, systems running, security lights tracing the perimeter each night. A monument not to wealth's power, but to its limits. Walking away wasn't failure, it was optimization. From a purely financial standpoint, the original buyer made the correct decision in late 2020. Walking away protected their remaining capital and eliminated a cash drain that was compounding losses monthly. Continuing to hold the property would have required either refinancing, which was impossible, or servicing the debt from liquid assets until a buyer appeared. Given the property's $6.5 million annual burn rate, holding for another year would have consumed an additional $6 million in cash. Holding for 2 years, $12 million. Each month without a sale made the loss worse. The buyer's net worth was still substantial. But liquidity was constrained. Other business ventures needed capital. Markets were volatile, making asset sales poorly timed. Defending the mansion position would have meant starving other opportunities. Walking away meant accepting an immediate loss of roughly $18 million, initial equity plus carrying costs already spent. But it capped the loss. No further cash would flow toward the property. The buyer could redeploy capital elsewhere, rebuild liquidity, and move forward. This is strategic abandonment, not surrender. Optimization. Recognizing that defending a position costs more than retreating. It is the same calculation corporations make when they shut down unprofitable divisions, or investors make when they sell losing positions to preserve capital. Emotionally, it was painful. The mansion represented years of planning, vision, and effort. Walking away meant admitting the assumptions were wrong, the models were flawed, and the outcome was failure. For someone accustomed to success, that admission is difficult. But emotional attachment to failed investments destroys wealth. The ability to abandon a losing position without hesitation is what separates successful investors from those who go bankrupt defending pride. The buyer walked away. They took the loss, preserved liquidity, and redirected focus to ventures that still had potential for positive returns. From a financial optimization standpoint, it was the rational choice. The question that lingered was not whether abandonment made sense. It was why the project had been structured in a way that made abandonment inevitable. This mansion isn't ruined, it's preserved in limbo. Abandoned properties typically decay. Copper is stripped, windows are broken, vandals leave marks, weather accelerates deterioration. Within years, they become unsalvageable. This mansion is different. It is abandoned in form but maintained in practice. The bank continues paying for climate control, security, and basic upkeep. Not out of sentiment, but calculation. Allowing the property to deteriorate would destroy whatever residual value remains. Maintenance preserves the option to sell, even if that sale is years away. The result is a strange kind of abandonment, clean abandonment. The property sits empty, but systems function. Lawns are mowed, pools are chemically balanced even though no one swims. Security cameras record hallways no one walks. This is economically rational but surreal. The mansion is performing all the functions of occupancy except the actual presence of people. It is a stage set maintained for a performance that never occurs. The systems run to prevent decay, but they serve no living purpose. They are preserving potential rather than supporting use. Visitors to the neighborhood occasionally ask about the property. Real estate agents familiar with the area know the story, though they discuss it carefully. The mansion is visible from the water, photographed by boaters, whispered about at local clubs. Everyone knows it is empty. No one admits publicly why. The locals understand something about extreme wealth that outsiders miss. At a certain level, properties stop being homes and become problems. The mansion is not a failure of construction or design, it is a failure of scale. It was built beyond the point where functionality matters more than grandeur, where utility justifies cost, where someone actually wants to live there. The bank's carrying costs continue, $150,000 per month, over $1.5 million annually. Added to the loan loss already recognized, the total damage to the bank's balance sheet exceeds $12 million and grows with each passing month. Yet they hold. Because selling at $35 million would crystallize a loss of over $20 million. Management cannot justify that to shareholders. Auditors would question why the property was financed at such aggressive terms. Regulators might examine lending practices. The pain of holding is preferable to the pain of capitulating. So the mansion waits, perfectly preserved, entirely useless. A monument to a mistake that no one can afford to acknowledge. This isn't rare, it's quietly common. The mansion described here is not unique. Similar properties exist across luxury markets worldwide. Structures built at costs that market pricing cannot support. Projects financed on assumptions that proved incorrect. Assets abandoned by buyers who could afford construction, but not the consequences. In Los Angeles, a spec mansion built for $500 million sat unsold for years before selling at auction for $140 million. In London, luxury developments completed during market peaks remain partially empty, units owned by shell companies and left dark. In Miami, penthouses purchased pre-construction at record prices are now listed at 30 to 40% discounts with no buyers. The pattern is consistent. Developers or buyers assume that because extreme wealth exists, buyers for extreme properties will materialize. They model appreciation based on past performance. They structure financing that requires quick sale or refinancing. Then markets shift, liquidity disappears, and the assumptions collapse. What makes this repeating pattern disturbing is that it involves sophisticated actors. These are not speculative flips by inexperienced developers. They are projects financed by major banks, advised by top-tier consultants, appraised by credentialed professionals, and purchased by billionaires. Everyone involved should understand the risks, yet the mistakes recur. The reason is structural. Luxury real estate at the highest levels operates on narratives as much as fundamentals. The narrative is that billionaires are irrational, that they will overpay for trophies, that scarcity and quality command premiums disconnected from construction cost. Sometimes the narrative proves correct, often enough to keep people believing. But markets are more rational than narratives allow. Even billionaires analyze opportunity cost. Even the ultra-wealthy avoid tying up capital in illiquid assets during uncertain times. The buyer pool is smaller than developers assume, more price-sensitive than sellers expect, and far more patient than sellers can afford. Each failed project carries lessons. Build for resale, not personal vision. Price based on market, not cost. Maintain liquidity, not leverage. Exit before carrying costs compound. Yet the lessons are rarely applied, because the next project begins with optimism, and optimism erases memory. The mansion sits as a physical reminder that wealth does not immunize against bad assumptions. That confidence is not the same as certainty. That markets punish mistakes regardless of how much money made them. Other properties will follow. They are under construction now, financed on models that assume liquidity will exist when needed. Some will succeed. Many will not. The cycle continues because the incentives never change. Developers are rewarded for scale. Lenders are rewarded for volume. Buyers are motivated by status. No one in the chain benefits from caution. So mansions continue to rise, and some, inevitably, will fall. Chapter 16. What this mansion was really built. For the mansion did exactly what it was designed to do, just not for living. Looking back, the mansion succeeded perfectly at its intended function. It was never really meant to be a home. It was meant to be an asset, a vehicle for storing and growing wealth, a balance sheet entry that would appreciate while requiring minimal attention. The mistake was not in the conception, but in the assumptions underlying it. The buyer assumed that assets of this type were liquid, that markets would provide exit whenever needed, that cost would translate to value automatically. These assumptions were wrong, but they were not irrational. They were based on years of experience in markets that had rewarded similar thinking. The mansion performed exactly as designed for a financial instrument. It absorbed capital, held value on paper, and waited for monetization. What it could not do was generate liquidity when the owner needed it. That failure was not a flaw in the mansion. It was a flaw in how the mansion was classified. Treating an illiquid real asset as if it had stock-like liquidity was the error. The property itself functioned fine. From the bank's perspective, the mansion also served its purpose. It allowed the institution to deploy capital into a wealthy client relationship. It generated fee income from loan origination, servicing, and eventual restructuring. Yes, they took a loss, but the relationship with the borrower produced other business: investment management, advisory services, banking for the buyer's companies. The mansion was one transaction within a larger portfolio. Losses in one area were offset by gains elsewhere. From the architect's perspective, the project was successful. They designed a structure that met specifications, won awards, appeared in architectural publications, and enhanced their reputation. They were paid in full. Whether anyone lived there was not their concern. From contractors' perspective, the project provided years of employment. Craftsmen earned wages, suppliers sold materials, consultants billed hours. The mansion supported hundreds of jobs. It functioned as economic stimulus, redistributing wealth from one billionaire to many workers. The outcome for the buyer was irrelevant to those who built it. Only from the buyer's perspective was this a failure. But even that is debatable. The loss was painful but survivable. The buyer's net worth recovered as other investments performed well. The mansion became a story, a cautionary tale shared privately among peers. Expensive education, perhaps, but not ruin. The mansion exists in a strange purgatory. It is not abandoned in the traditional sense. It is maintained, functional, ready for occupation. It simply has no occupant. It is a perfect machine with no one to operate it. A stage set awaiting actors who will never arrive. What does this mean? It means that at the highest levels of wealth, properties stop being about living and become about financial engineering. Success is measured not by whether anyone enjoys the space, but by whether the asset performs its role in a portfolio. If that role is storing value, the mansion succeeds by existing. If that role is generating returns, the mansion fails by being illiquid. The contemporary ultra-wealthy understand this better than the Gilded Age builders did. They do not build palaces anymore. They buy apartments in multiple cities, none remarkable, all liquid. They lease rather than own. They invest in assets that can be sold within days, not months. They have learned the lesson this mansion teaches. Liquidity is more valuable than beauty. Flexibility is more valuable than grandeur. Wealth that can move is more powerful than wealth frozen in stone. The mansion stands as a monument to the moment before that lesson was learned. It represents the last breath of thinking that buildings could be both artistic achievements and sound financial instruments. That one could build for eternity and still preserve capital. That era has ended. Not because buildings are no longer beautiful, but because beauty at this scale and cost is simply too expensive. The iron gates still open every morning. Climate systems still hum. Security lights still trace the perimeter. The mansion waits, maintained and guarded, for a purpose that may never come. It did what it was built to do. It stored capital. The problem was that capital, once stored, could not be retrieved. And so the mansion remains, not destroyed, not forgotten, just unused. A perfect failure, a beautiful mistake. A warning in marble and glass that wealth is not enough. Not without liquidity, not without timing, not without luck. The mistake was not building the mansion. The mistake was believing the mansion could be sold,